Chapter 6, Part 1. We're going to go over the new revenue recognition rules, which have become more complicated because you no longer just go someplace, give them money, and they give you the product. That our world has changed, so it's gotten a lot more complicated. So this is their definition. A company recognizes revenue when goods or services are transferred to the customers for the amount the company expects to be entitled to receive. So what does that mean? Well, I think the big challenge is when. When do the goods actually transfer? Is it the moment there's an exchange, or is it going to be over time? And how much the person is entitled to receive. An example would be if there's a right of return, that is going to affect how much you're going to be entitled to receive. So it is important not only to determine how much revenue to recognize, that's what you're going to record, but also when to recognize it. So now let's go through these 5 steps they've come up with. First thing we need to do is identify the contract. The contract is the legal rights of the seller and the customer. Identify the performance obligation. What do you actually have to do? A performance obligation is a promise to transfer a good or service that is distinct, which is in the case if the goods or services is both capable of being distinct and separately identifiable. Now, we can have single performance obligations or multiple performance obligations. Now, multiple would mean is you buy a piece of equipment plus you get a option to buy more equipment, or you get an extended warranty, or they allow you to upgrade to something else. That you have to put a dollar value on. Now, the thing to remember is a right of return is not a performance obligation, but instead it is called a variable consideration that will reduce the revenue at the point of sale. Now, the next step is determine the transaction price. This is the amount seller is entitled to receive. Then we're going to allocate the transaction price. Now, we have what we call again performance obligations. We call them POs. So if there's only one, no allocations required. And again, remember, variable consideration only affects potential revenue. And then we can have multiple performance obligations. We have to identify these. Step 5, we need to recognize revenue when or as each performance obligation is satisfied, whether it's single, at a point in time, or over a period of time, or multiple, at whatever time is appropriate for each performance obligation. So now let's go over an example so you can see how this works, and we'll walk through the 5 rules. So in this example, Mike sold 10 vacuum cleaners for $500 that included a 1-year warranty that covers any product defect. When the customer buys the vacuum, they have the option of buying an extended warranty. So how many performance obligations do you have in this case? Well, we'll go through our rules. 1, identify the contract. The contract was signed to provide 10 vacuum cleaners. That's when the contract is established. Doesn't mean we book any journal entries. Next, we have to identify the performance obligations. And in this case, we have just one. Provide 10 vacuum cleaners. The warranty is given to everybody, so it's not considered a separate obligation. Determine the transaction price. In this case, it'd be 10 vacuums times $500 each, which is $5,000. And then allocate the transaction price to the performance obligations based on fair market value. There is only one performance obligation of $5,000. And then when the vacuums are delivered, they will be able to recognize the revenue. So, what would our journal entry look like? The accounts receivable, we assume unless they did a cash transaction, and the offset would be sales revenue. And of course, we would have, which they didn't include, we would have cost of goods sold, credit to inventory. Now, what happens recognizing revenue over a period of time? Now, revenue can be recognized over a period of time if any of the following, any one of them, is met. 1. The customer consumes the benefit of the seller's work as it is performed. An example would be a cleaning service. The customer controls the asset as it is created. Example would be a construction site. The seller is creating an asset that has no alternative use to the seller, and the seller has the legal right to receive payment for progress today. Example would be an order of jets customized for the U.S. Air Force. Revenue is recognized in proportion to the amount of performance obligation that has been satisfied. So now let's look at another example. In this case, Company A signs a contract to provide equipment, including installation. So they're going to have equipment. They're going to get equipment. They're going to have installation. And they're going to have a 2-year service agreement. Now, the equipment by itself sells for $1 million. The installation has a fair market value of $60. The service contract has a fair market value of $40 if they were sold separately. And the cost of the equipment is $550,000. The equipment is delivered on June 1st. The installation is completed on August 1st, and payment is received on September 1st. What are the journal entries? Now we'll go through our 5 steps. Number 1, identify the contract. The contract is to provide equipment, installation, and a 2-year service agreement. Identify the performance obligation. Well, we have 3 because we're going to provide equipment, we're going to install, and we're going to provide service for 2 years. Determine the transaction price. It's $1 million. And it has to be allocated to those 3 obligations because they're going to be provided over different time periods. Allocate the transaction price to each performance obligation. Now, we use fair market value to determine the percentage of the price that is allocated to the 3 obligations. And then we're going to recognize the revenue as each performance obligation is satisfied. So now, allocating the sales price. First, we determine the total fair market value. Then, we use this to determine the percentage based on fair market value. So the equipment of $1 million is divided by the total fair market value, and it gets 91%. And then we do the installation, and then we do the service, and make sure your percentage equals 100% or 1%. No, I'm sorry, 100%. Now, allocate the sales price based on the percentages. So, we're going to take each one of these, the $1 million times each one of our percentages. Now, remember, this must always equal $1 million because that's the total sales price. Now, what are we going to do? Well, what happens when the contract is signed? Nothing. On June 1st, when the equipment is delivered, we can book the equipment. We would book accounts receivable of $1 million, unearned service revenue for the installation, for the service, and we would. Now remember the new rule under the revenue recognition. It used to be that you could only book unearned revenue if you received cash in advance. Well, that changed under the new revenue recognition principle. Now they're saying you can recognize unearned revenue when you have a contract, because you should set up the liability at that point. And we can book our sales revenue just for the equipment, and of course when we do that, we want to make sure we book our cost of goods sold. Then the last thing we have to do is we need to book our installation, recognize the revenue. Then we have to book our payment. And then the last thing we have to do is start allocating the service revenue, which would have been 5 months. We take the 36,000 divided by 24 times 5 months, and there's our journal entry. And that concludes part 1 for chapter 6.